for the time being. All right, so the first question came in by email. Bill says, I'm a conservative investor by nature. Right now I'm trading bull put credit spreads that are 30 to 45 days until expiration. Now I try to find a bullish pattern that is trading above a support level. Place my short at least 12 to 15% out of the money. The question, if the stock breaks the support level early, should I take my lumps and move on? Or since there's still plenty of time until expiration, give it some room to play out whatever is causing it to slide? Well, there's a couple of contexts we have to take into account with that question. And of course, there's nothing wrong with using the support line as a trigger. You might use other things depending on what criteria you use to open the position. I'll talk about that in a moment. Now, there's still plenty of time to expiration, assuming it happened about halfway between when you open the position and your expiration date. And the key here is, do you give it some room? Perhaps, but you can also make an adjustment depending on your structure to give it some more room without technically hurting the position too much. And whatever is causing it to slide, that is the key. Whatever is causing it to slide, and what is the potential for further losses on the position. So let's take an example. April 2nd, of stocks trading around $45 per share. Going about 12% out of the money or so would be about, 39, 38, 70. So let's sell the May 8th expiration, 35 days out in time from April 2nd, the May 38 put at $315, and buy the May 36 put for $277. It's a pretty high return. It's a good net credit of 38 cents, 23.5% return. We're roughly 12% out of the money. 15 days later, at the close of today, the stock's trading at $38.92. Okay, now, cheating a little bit, picked a stock, a security I knew that was falling, so here we have it highlighted. Stock was still above the 20-day moving average, but the Bollinger Band, I apologize, Bill, the MACD was falling. I'll explain why I'm saying that in a moment. But we would have opened the trade here, and as we see, it's falling close to our short put strike price and probably fell below where we had marked the resistance looking at a 3 or 4 month chart. Okay, now let's talk management. We're going to pause the screen. I'm going to navigate over to Power Options. Now let's change our screen over. Perfect. Okay, so here's our trade details for VXX. We sold the May 38 put, bought the May 36, May 8th. Net credit of 38 cents, 23.5% return, but as you can see now, the stock is falling to our price and the support line as well. Now, we have a variety of webinars, which I'll link to in just a moment, on credit spreads, our preferred technique for bull put credit spreads, which is different than yours as well. But 30 days out, 40 days out, 20 days out, 12 days out, whatever it is. When we originally opened a position, we probably had our criteria in mind. Yours was looking at support, perfectly fine, nothing wrong with that. Okay, and at the same time, you wanted to be 12% OTM as part of your trading plan, 12 to 15% OTM. Now, in my positions, what I typically look for is an 85% probability or higher. That would still probably put us in the same range that you're looking at, 10 to 12% out on a 30-day time period. I also like to open a position when the stock, as you mentioned, is above a trend line, 20-day, 50-day moving average, and I also look for a positive MACD. Some of you, I'll just write this down, MACD, some of you investors online with us might be trading spread trades where you use delta. Instead of an 85% probability, that short strike price, the pivot point of your bull put credit spread, you might look for a delta of 0.20 or less, maybe even 0.15. Why am I bringing all of this up? Whatever you use as a criteria should also be part of your management technique. And you're using a support line, which is good. But you could also consider the 12% OTM. What do I mean by that? Would you consider, Bill, opening a new bull put credit spread if your position was only 6% OTM or 5% OTM? this might be another trigger you might consider to use for management of your bull put credit spread. So if you're now in a certain range where you're less than 5% out of the money, where you wouldn't open this new position even if you had 12 or 15 days left, that plus going to the support line might just be a trigger, 2 out of 3 of your triggers to potentially close the position. Okay? Now, I had mentioned my 85% probability at the MACD. If I start to see a negative MACD crossover that starts to reverse, that's one of my 3 signals I'll use. If the probability drops below 70, that's a confirming trigger. And then if the stock drops below the SMA 20, all 3 of those are hit, I'm likely just going to close the position to avoid further losses. I'm not necessarily going to roll the position. I'm not going to try to do a fancy adjustment because I want to keep to my trading plan. And if I keep an 85% probability and I keep the losses on the 15% of a time frame to under 50%, say under 49%, and still make my target of 11 to 12%, actually it's closer to 14% when I'm right, that's still a winning track record. We've proven that in some of the webinars I'll point you to in a moment. Okay, so a trading plan is key, Bill. But what are some of the things I could do now? We talk about this too. We'll show you the full webinar on this, but we're going to review it very quickly. We typically discuss 8 ways to manage, okay? Hold on one second. James, I'm going to take your question, your comment you just threw in 1 second, okay? James says, wait a minute. If it's 12 to 15% out of the money, would it be the same as the 85% probability? No. That depends on the stock, okay? It's not as clear cut. An 85% probability above might equate, James, to a delta of the short option of, say, between 0.13 to 0.20, another way to use it. But 12 to 15% out of the money does not dictate necessarily it's an 85% probability. 85% probability is a little bit closer to having a 15 delta on your short option as opposed to that. But we'll take a quick look at that in just one moment. So here we are. Now, sidestep for Bill. I had mentioned one thing that when I do the 12-day out, 14-day out bull put spreads following the weekly bull put search when I feel it's time to do bull put credit spreads. I got a couple open right now. But one of my rules, since I have a shorter time frame, is rather than half of your initial 12 to 15% out of the money, using maybe a 6% or 5% of the money as a trigger, I usually use a 1% rule. If the stock falls within 1% of my short put strike price here at 38, that's another of the 3 or 4 triggers I'm going to use with the MACD, simple moving average, of course, and the change in probability. Actually, if it's within 1%, it's probably down to a 60% probability or 55% probability at that point. All right, so in any case, here we are. About 14 days left to expiration of May 8th here on the 17th. Okay, so I'm sorry, it's a little bit more than that. It's 20 days. What are the 3 things I could do? 1, do nothing. Okay, so we can do nothing on this position, see if the stock recovers and moves back up. And this again points to the reason. What was the reason for the decline? Was it poor earnings? Was it poor information? Sam offers a great comment. Don't forget to be informed about the news. It plays an important part in the stock moves. Apple, of course, was dropped on a downgrade, probably in a pre-assumption of what the earnings are going to be or what can happen as well. Okay, now, so do nothing, but that depends on the news, the current market conditions, and the outside situations that caused the decline in the first place, all right? With Apple being downgraded, the market is still trying to show a little bit of strength right now, but we know a lot of earnings are coming up soon, so it could continue to fall. I don't want to increase the potential losses on this position, so what I might do now is number 2, just close. As you mentioned, Bill, close, take the loss, and move on. The advantage of doing nothing is that you still have time. The advantage of closing early, and by the way, to close this, it would cost a debit of 67 cents right now, the way that this stock has fallen. That's less than half, that's less than a 50% loss of the maximum 162 I could lose on this position, about a third of the full $2 monetary requirement from the difference in the strike prices. So this is a benefit here, is to take this loss of about 38 cents. It's cost me 67 to buy it back, Bill. Take that loss there of about 29 cents only and make it up with new positions going forward that have a better trend. I'm going to highlight this, circle this 50 here. That's important. Once the spread hits a 50% loss, it's very hard to manage unless you want to go 90 days out in time, or I'd have to increase the strike prices. So what's half of my full risk of $2? It'd be a loss of $1, liquidating for $1.38. Am I going to get a $1 credit on a 2-point spread rolling out in time? No. I'm going to have to increase this to maybe a 5-point spread, 10-point spread, increase the strikes, which increases the risk. Now we get back to Sam's point, and now we get back to the point of why is the stock falling. If I try to overmanage this bull put credit spread, I roll out another 60 days or so, and I have to try to get a credit of $1, so I increase the strike difference to 10 points or 5 points now, double or triple what I originally had, and the stock continues to fall. What would have been just a 29-cent loss or maybe just a dollar loss on the position now could become a $3 or $4, which means we're wiping out 10 previous potential trades. That's where the risk comes in of managing. Number 3 is perhaps roll the whole spread down. Close your initial, roll down to lower strikes, but may involve increasing the strike prices, which is going to be an increased risk if it continues to move against you. Management has its pros and cons. Now, something that can work and something that I do occasionally, I used a 2-point spread on purpose from the 36 to 38. One management I might be able to do is buy to close the short and roll it down to the next strike. So I could move the 38 down to the 37. Keep the 36 open. Now I just have a 1-point spread, and if I still have a credit, hey, it's not a great return, but now I still have another dollar cushion in case I think it's going to recover. So that would be close the short position. Okay. Now, there's a couple more we should talk about. Number 5, of course, is you could do an iron condor. Meaning, okay, the stock fell from where it was at 45. It's down to 38. Well, if I think the stock's going to stay in this range, recover a little, maybe I could do a 43, 45 bear call credit spread that's going to increase the premium and give me a wider upper to lower break even. What's the main issue with doing this iron condor? By adding the bear call spread and doing the iron condor, I have not stopped what's losing on the position, the bull put spread. If the stock continues to fall, what's happening? I'm still losing on that bull put. Yeah, I got a little bit extra credit, but I haven't solved the problem. That's one of the risks of trying to do a butterfly or an iron condor repair from a standard vertical is, depending on your broker, you may actually double the margin. They might not see this as an iron condor for me. They may see this as a bear call spread and a bull put credit spread separately, Bill, so I may have to cover both margins. It also doesn't, it gives you more cushion. It gives you more credit. It lowers your lower break even, increases your upper break even. What doesn't it do? It doesn't solve the problem if the stock continues to fall of taking a loss in this area where you could have minimized it to the loss up here. Okay. Another one that we talk about is the pendulum adjustment. That one's not here right now. If it fell quickly and dropped between the strike prices, you could roll this position just the long to a higher strike and in one move convert the bull put credit to a bear put debit spread as the stock continues to fall and have a profit to the downside. The pendulum adjustment, typically, that's usually number 8, but the pendulum adjustment typically only works when the stock has fallen between the two strike prices, not when it's threatening at this range or going through as well. Okay. Another one that we talked about, number 7, is similar to this, what I talked about, the pendulum. I could close the bull put as we talked about in number 4 and then open a bear call credit spread on the same stock. Do the opposite. Close and do the opposite as well. Okay, so those are some of the 7 ways to manage a technique. I know I'm missing one, but that's all right. So if you're at your support, Bill, to answer your question directly, if you're at your support, my suggestion would be to set up other triggers for your trading plan as sort of a checkbox. If 2 or 3 of your conditions are met, you may just want to close the position. If only one is met, you may want to consider rolling, adjusting the position, but research and analyze the position as a brand new position, not as what you're managing. What do I mean by that? Exactly what Sam said, exactly what we were talking about. Look at the news, the reason for the decline. And if you're looking at the stock brand new, with the news and the chart that you're seeing, would you open a new position 30 days out that was 12 or 15% out of the money? If your answer is no, then you probably don't want to try to manage. You just want to close, take your lumps as you mentioned, keep it to a small percentage of the maximum loss if possible. Make it back up with other positions as well. Okay, so first things first, though, I promised here that I'd show the webinars. So at any time, remember, you can go to the webinars page, click free webinars underneath the main home tab. And of course, you can also just go to this directly. This is a public page. 4 categories: tools, option strategies, concepts, requested topics. Click on option strategies. We're going to scroll down a ways here. And let's see, back down here, we've got some of the this managing covered calls. Give me 1 second. It's not that far back, is it? No, I went too far. I'm sorry. Hold on, folks. I am sorry. All right. There it is. 8 ways to manage your bull put credit spread from 2018. Our preferred 8 ways to manage the bull put. Trigger points to know when consider managing. Pros and cons of each adjustment, and why it may be okay just to close the spread. Get a trading plan of how you can manage the position based on that as well, okay? All right. Okay, so let me see here. Okay, Eileen, you're going to be next, and then followed by Octavio. Okay, Jerry says, what about rolling the position down? Let's go back. Oh, sorry. Jerry says, what about rolling the position down and increasing the number of contracts? Okay, similar thing as increasing the number of strikes. That increases the risk, right? You have more contracts, you have more monetary risk on the position. It almost has the same effect of increasing the strikes and keeping the same number of contracts, okay? You're increasing the risk but trying to get the monetary value back by taking in a higher number of contract size. So instead of just the one contract here, taking that loss of $67 that we mentioned on this position right now, or liquidating for $67 and taking a loss of $23, that's not that bad. But let's say we closed it for $1 and the loss right now is $62. Again, about a third of the maximum risk, really less than half of the true maximum risk of 162. Now I go up to 3 contracts of another 10 to 12, 15% out of the money spread another 30 days out, and I can get another 30 cents, which is actually 90 cents. But now the risk goes up to 600. It'd be the same principle as increasing the strike, same effect. You can get the money to repair it that you lost on the position, but you're going to increase the risk if the stock continues to fall against you. Okay, that's the trade-off. There's nothing wrong with doing that, Jerry, but again, it has the same effect of increasing the strikes. You're increasing the risk on the position. Okay, you can make it back, but you're taking that chance of the risk, and if the news for the reason of the decline continues on, you could see higher losses. Okay, I am going to go to a chain very quickly now because we're going to cover James's follow-up during this conversation regarding 12 to 15% out of the money. And we'll just use something normal. I almost put an Apache, but Apache is an old oil stock I used to track, which was a nice $40, $50 stock, but recently it's fallen to $8 per share. Okay, this is going to look a little busy, but we're going to clean it up for you. Okay, so this is way too busy. We need to look at 3 things. Percent out of the money, delta, and probability, as well as the price and some others. So I'm going to go to Add Remove Columns. Anytime you're in a Power Options search or a chain, you can customize the column view based on what you'd like to see. Okay, so we got to leave the put option bid, put option ask. I don't need update time, volume, open interest. Implied volatility we might leave in. We're going to leave in the delta. And let's see here. Oh, sorry, folks. Leave in the delta. Don't need time value, percent time value. I need percent in the money and the percent probability above. Okay. So we know Apple is, as we talked about a couple of weeks ago here, as we talked a couple of weeks ago here, Apple, like many, the implied volatility is still about 2 to 3 times the norm. All right. Now I'm going to April 24th. And let's go to, we have to go to medium chain. I apologize. For 7 days out, this is an important topic for what you said, James. For a 7-day out or 14-day out position, here's our range out of the money. So 12 to 15% out of the money is closer to a higher probability for a smaller trade, a 7 or 14-day trade. You're looking at probabilities of 90, 99, 93, and beyond. That's for next week, 7 days away. It doesn't, we're talking about the 240, 247 and a half strikes, okay? Monetarily, those are 12 to 15% of the money, but they have a very high probability because it's only 7 days for Apple to drop 12 or 15%. Now, we've seen that happen in recent market conditions. But again, now what happens if I go 30 days out from today? We go to May, expiration on the 15th. We go to our targets of 10 to 12 to 15% out of the money. So we're in this range, okay? And what does that equate to? That's sort of a 92, 81, 85, so close. 12% is about 85 for 30 days out. 15% is closer to a 92. Look at the deltas, though. So here, a delta of 0.13, kind of close to 12% out of the money, but at 85.6% probability. So they are kind of close in this case, 30 days out, James. But when you go closer in, the probability is going to be much higher, and the delta is going to be much lower for the same range numerically out of the money, because now there's 30 days for the stock to move down 12 or 15%. So everything kind of goes hand in hand the further out in time you go. As you can see, in 30 days out for this stock, with an implied volatility of around 0.49, 0.5, somewhere in that range, James, it's not too far off. 12% OTM is about an 85% probability. 15% OTM is about a 92% probability with only about a 0.7 delta. If I look at a biotech stock, same price, around $280, but with a volatility of 1.3, 1.4, or a higher stock volatility than Apple has, these probability values are going to change even though you're still 10, 12, 15% out of the money. And in normal days, James, when we're looking at Apple, when it had its normal volatility range of, say, 0.25, or if we were looking at SPY with a normal volatility of 0.12, well before all the coronavirus corrections and things still happening with the various world economies, we could go 10 to 12% out of the money for a 1 week out trade and be at a very high probability. 30 days out, this would probably be a higher probability because there's less of a chance of the stock moving. When this situation, 12 or 15% out of the money, with double the volatility on the stock or the options, you'd expect to see a lower probability. That's how it all works hand in hand. So it's not always that 12 to 15% of the money is an 85 to 92% probability. It depends on the stock, the volatility, and of course, past trading action, which is incorporated into the volatility as well.